everybody. Today is July 8th, 2014. This is our weekly Options Tribe meeting. And I just want to start the meeting by pointing out that this session is intended for educational purposes only. We're not really going to be seeing any positions today that are live. We never really do show live positions here on the Options Tribe. Any hypothetical computer simulated results or pricing or whatever are just that. They're hypothetical, and they are going to be different than your ability to execute them because of slippage, commissions, and liquidity. Options trading is risky, and you need to understand options trading risks prior to exposing any of your capital to options trading. Your online broker has documents which can explain those risks to you. Please get them and read them and trade very, very carefully after that on small capital until you are competent, and always trade a small amount of your overall net worth so that if something negative happens, you'll be able to continue your style of living. So having said that, I would like to welcome back today to the Options Tribe, and we've never had these two gentlemen as a team, Tom Nunamaker and Jim Riggio. And they're going to be talking about a very, very important topic today, a topic that very few people really understand well, yet it's so critical to options trading in so many ways. It basically, from my perspective, option synthetics explain pricing in the market. And if you understand pricing, you can understand what to expect when you're trying to execute an entry, an adjustment, an exit to a trade, and so forth. So it's an absolutely critical topic. It's not well understood. This is the kind of, this is the reason that you're a member of the Options Tribe, to drill down a little deeper into very important topics, and hopefully it'll make you a better trader. So with that, I am going to turn the presenter mode over to our two distinguished guests. Jim, by the way, everybody knows Tom. Hey, Jim, you are still calling your website Capital Discussions, is that right?
Yes, it is.
Okay, good. Terrific. And just explain to me how you came up with that name again while I pass the baton to Tom.
Tom and I looked at it, and we were too cheap to end up buying any of the names we really liked, so that was the one that we could get for free.
That's as good
Tom, is that about sum it up?
as any. Hey, Berkshire Hathaway, I think, was like a clothing company, some kind of a company that made shirts. It was sort of bordering on bankruptcy when Buffett bought it.
Yeah, it was his. I think it was his second. It was his second company, and when people ended up suggesting to him, he ended up changing it. True to his form, he liked things to stay the way they were unless there was a good reason to change. So he never changed it.
Well, it's taken on a different meaning than a borderline bankrupt shirt manufacturer.
It certainly has.
So, Tom, Jim, why don't you fire away?
All right, so can you see my screen?
Yes, I can.
Okay, great. So for those who don't know me, I'm Tom Nunamaker. This is the, basically I think it's the same disclaimer that you just showed a minute ago.
Yes.
But it is, again, for educational purposes only. We don't know you and your particular situation. And this is basically our disclaimer, which is pretty close, but, similar idea, educational purposes only. So if you want to go ahead and follow along, you can actually download the slides if you go to this URL, cdurl.com/OT3, all lowercase. So if you want to, the PowerPoints are there, and you don't have to worry about writing things down. It's all right there for you. And I'll have this at the end of the presentation too, so if you miss it now, I'll come back to it.
Thank you.
So what we're going to talk about, a couple things. A put-call parity is an equation that shows the mathematical relationship between puts and calls. Then we'll go through synthetic covered calls and how you create those. A collar, and compare that to different vertical spreads and how they're derived from the synthetic relationships. How you can buy or sell an index, future stock with only options, and Like an index, if you're going to go short an index, that could be called like a risk reversal too. Synthetic underlying positions with different strikes, those bring up some interesting possibilities. And then something I've never heard anybody actually talk about, rotating the risk chart. The effect that you have when you buy stock or do synthetic stock is it actually rotates the chart of the existing position and using the current price as like a pivot point. So it's kind of it gives you some more interesting possibilities. And then the last thing we'll talk about is a box trade. And I had to use that. I was talking to Jim about this with some futures options a while ago that were really hard to get rid of, but I used the box to neutralize the risk, let it all expire, and it was all good. So that's the big picture. So let's start off with the put-call parity equation. So here's the equation. The call minus the put equals the underlying minus the strike plus the interest minus the dividends. So not too hard to understand. And for most of the stuff that we do, especially with interest rates so low, we can take the interest rates out of the equation, and the dividends, if we're trading indexes, that's also out of the equation. You know, if you're doing something that has dividends, it's a small part, but for our purposes of simplification, we're just going to ignore it. And the strike price is a constant, so we're just going to drop that. And that leaves a very useful equation. The long call equals long stock plus a long put. And I first saw this in Charles Cottle's book, and I always loved it. It's a really easy way to remember it. So CUP. And here it is, you know, the long and the shorts for each of the components. Now, if you remember in algebra, if you want to move one thing to the other side, you would subtract like the calls from both sides, and effectively, like my 8th grade algebra teacher said, when you jump the fence and the equal sign is the fence, then you change signs. So when you put the C over here, it's minus. When you put the U over here, it's minus, and the P on the left is minus. So once you know how that works, then you can derive these essential synthetic relationships. So like we talked about, the call equals long stock plus put, and then if you just multiply everything by -1, you get a short call equals short underlying and short put. And you can see all the different combinations. It's just simple algebra, but you know, you can just keep it in your head what's what, and we're going to see that in a minute with the covered calls, because a covered call is long stock and a short put, right? So, or long stock and short call, which is right here at the bottom. So we're going to show that. So here we go, synthetic covered calls. And I just answered this, but a covered call is long stock short call, and then that's equal to a short put. And the graph doesn't look exactly the same because I didn't scale it right, but they are exactly the same position. They don't have the same margin, but they have the same risk. And the danger, if you do covered calls, I know there's a guy out there that has a program where he does, you know, married puts and covered calls, and he says a covered call is not the same as a short put. And in a sense, he's right in that they're different margin, and you can load up on more short puts than covered calls because the stock's more expensive, and you can actually put on more risk. But if you want to create synthetically identical positions, you can, and the short put's going to cost you less in margin, you know, for the same risk profile. So
Tom,
let's talk about,
and that margin comment is true for Reg T, but not for portfolio margin.
That's interesting.
Now, it's interesting. Who makes up the Reg T margin requirements? A bureaucrat in Washington. Who makes up the portfolio margin requirements? Your broker who's taking on the risk. Okay,
Yep.
So your broker knows a little bit more about the actual risk, and so that's the one that's equivalent, and you actually do have the same risk. The Reg T stuff, in my opinion, doesn't do a great job of actually telling you what your real risk is.
Right. Good point. Okay, so a collar. So typically you'll see a collar if somebody owns stock, and then they sell a call, in this case above the price of the underlying, and then they buy a protective put below the stock price. in this case, they were the same, so this would be a zero cost collar because you sold this for 33 cents and they bought the put for 33 cents. And that gives you this type of shape. Well, if we look at it a different way, the collar is really long stock plus the short call above and the long put below. Well, long stock plus the short call is a short put, so you have the minus E is that. So you end up, if you substitute that, you end up with a long put and a short put, which is a put vertical spread. And you can also look at it the other way. If the long stock plus the long put is a long call, then you have a long call and a short call, which is also a vertical spread, but in calls. So if you look at that in option view, this would be the put vertical, and you notice the shape looks very similar because it's synthetically identical. And then we'll look at the call vertical, and it's also the same shape. And one thing when I was learning options is when you're doing vertical spreads, when the sign goes from plus to minus, that's the direction that you want it to go. So in this case, the lower strike is positive, the upper strike is negative. That's a bullish spread. And if I go back a slide, this is a put spread, but the lower strike is positive, so the direction is flowing is up, and it's also a bullish trade. So if the negative one was below, it would be a bearish trade. It doesn't matter if it's calls or puts. So that's just something. It's kind of the put-call parity thing. They're all, a put's a call and a call's a put. I don't know if you've heard that, but that's the same out there. So if we compare all these three together,
I've always had a little trouble with that expression, by the way, because it's not actually a true statement when you're talking about an individual option, but when you're talking about spreads, it becomes true.
Exactly.
You know what I mean?
Yep.
Yeah.
So if we compare the three together, we have the collar, put vertical, and call vertical. The collar, the margin's so high because the stock, the put and call verticals are nearly identical. And these differences are probably just due to option view rounding. The deltas are dead on accurate, the same as the gamma. Theta is just a few pennies off, and then the vega is identical. And you can see with the risk graphs from all three that they look exactly the same because they're synthetically equivalent. So the next thing we'll talk about is buying or selling an index, future, or stock using only options. So to buy or sell the underlying, the long stock is a call minus a, call minus a put, and the short stock is a long put and a short call. If you use the same strikes, it's just like buying the underlying or, like a straight futures contract, straight stock. If you use different strikes, then that creates kind of a different profile, which is interesting, and you can't do that with the underlying. So if you do it the same strikes, it's just like the underlying. If you use different strikes, it's something you can't do with the underlying. So if you want to buy the Russell, now it'd be nice to go plus 100 shares of Russell Index and buy yourself 100 Delta, but you can't do that. It's not possible. But you can go a long call and a short put, and this is the same strike. So that is the identical position that you would have sold it, and you still have 100 Delta. And the theta is probably, again, a rounding error, but you can see no gamma, no theta, because they're offsetting. And then if we do a stock, the same thing. You can buy the stock, and here's the margin of 5,200. It's got to be on 50% margin. But if you use options to do the same position, the margin is much less. And again, like Jim said, so this is Reg T, so portfolio margin, they're going to be pretty close as far as margin requirements. So a risk reversal is, again, like selling the index like this, or you would just short the stock and go long the put. And it's not possible to do unless you use options. Okay, so this is where it gets interesting. This is where we start splitting the strikes. So suppose in this example we sell a strike that's 780 and we buy one for 590. That gives us a net credit. So that actually creates a position like this. So if you're bullish on a stock or an index, you can actually create a small profit zone if the stock sits there, and still have a bullish opinion on the stock. Now, you do have a delta that's pretty close to 50, so it's almost like buying a call, but the call has negative theta. This actually has positive theta. And again, you can't make money if it sells off a little bit. No, not too much, but it does give you some interesting possibilities because you can substitute this idea with things that use, like say the M3 that uses a deep in the money call. If you can't get that call on, maybe you could do a synthetic long stock instead and split the strikes and have a different kind of risk profile. But it gives you some new possibilities if you haven't thought of this before.
Is there a name for this, Tom? That trade?
This one?
Yeah.
It's just synthetic long stock with split strikes.
Mm-hmm. And Tom, one of the things about this position right now is that when you look at what you're doing there, you are selling a put below the money and buying a call above the money. Because the puts normally cost more money than, if you go equidistant in any of the indexes, the puts would cost more money than the calls.
Right.
So therefore, that's going to end up being positive theta. Now, what that actually is that's called skew. And right now, if you take a look at the relationship to how expensive a put is above the money versus how expensive a call is above the money, equidistant, or if you want to end up using equal deltas, we're basically at better than 2-year highs on and off over the last week. So this trade at this moment in time is going to be more positive theta than it has been in practically at any time during the last 2 years.
Mm-hmm.
And you can also put this on in reverse, too. So if you want to maybe hedge your portfolio to the downside, you could split it the other direction and add a long put, sell a call against it, have your synthetic short underlying with a split strike, and give you this kind of profile. So, it does increase your risk to the upside. Maybe you add some far out of the money calls to kind of limit your risk on the upside. But this could be a nice portfolio hedge for a flash crash.
John Dory, by the way, points out that the long call at one strike and the short put at another strike, he would call a risk reversal.
Yeah, I mean, it's a form of selling the index.
That's what Tom called it before, exactly.
Yeah. And John is calling the reverse a risk conversion. So what we're looking at right now is a risk conversion, I guess, right?
Yeah, that's what some people would end up calling that.
Mm-hmm. Okay.
Yeah. So it just gets the creative juices going. You can't do this with just stock or a future. You can only do this with options, which is part of the reasons that options have always been attracted to me, is that you can do these kinds of things and really be creative.
Right.
So again, you can't combine this kind of thing with any trade. It doesn't have to be just by itself. You could put it with butterflies, verticals, calendars, whatever you want. And that kind of brings us to the next point with rotating the risk chart. Now, when you buy or sell the underlying, it rotates the chart of an existing trade, and the rotation is at the pivot point is the current market price. And the rotation amount depends on the relative size of the position that's existing and the position that the stock is. So the bigger the position is, the more granular control you have over the rotation, the angle of rotation. And I'll show you what I mean. So here we start out with this short 10 puts in the Russell. Pretty expensive trade, but this is for illustration purposes. Mm-hmm. Now, if you synthetically add a short index, so I sold the 1180 call and bought the 1180 put, so that by itself is shorting the Russell by one unit or 100 shares, if you will. So if we look at the original delta of 194, now the delta is 94 because we've cut 100 deltas off of it. But what did it do? It took our existing short puts and took that whole risk graph and rotated it. I don't know what that is, the 5 or 10 degrees, or maybe 10 or 15 degrees. And just so you can see it again, if we do 2 units, now we sold essentially 200 shares of Russell. Now we're actually slightly negative delta. And you can see the more we sell, the more it's rotating that position down. So if you want to kind of take this covered call, short put type of position and maybe change the delta up a little bit, you can do a synthetic short and kind of neutralize that delta as much as you want. Now, if we take an extreme example, and we'll sell 100 shares or 100 puts and only rotate 200 shares, then it's a very, very small rotation. But it's always at that pivot point where the current price is. So you can kind of get a feel of, you know, if you're trading a lot of units, you have a lot more granular control over the rotation. But it's kind of an interesting idea that, you know, when you're buying or selling underlying, it actually rotates the whole risk graph at the current price. Okay, so the last thing is a box position. This is basically creating offsetting positions that create a flat risk chart. So you can freeze part of a position or all of it. And I found this useful when I was talking to Jim about this. I was trading ZB futures options, and some options were in the money, getting ready to expire. I had a profit in the trade, but the bid-ask was really excessive, like bid 4, ask 6. And if I tried to get the trade executed at what they wanted, I would have lost all my profit in the trade. So to neutralize it, you have to have 2 strikes, and you can use offsetting puts and calls. So in this case, we'll use a long gut strangle position as an example. We are long 100 call and long a 105 put, and that creates this strangle position. Now, to neutralize it, we just do the opposite. So we have a long 105 put, so we'll go a short 105 call. We have a long 100 call, we'll do a short 100 put. So that creates 2 synthetic long stock and short stock positions that offset each other. And that basically gives you a flat line risk, and you can see how they just totally neutralize each other. And that's what I did. I just created this box trade and let it expire, and I kept my profit. So, Jim, you had some other comments about a box, too. This is what the market makers used to do a long time ago.
Yeah, you know, one of the things that used to end up happening with market makers, when the bid-ask spreads were very wide, and you'll see this sometimes with very deep-in-the-money stuff, sometimes you'll end up having a much tighter execution, and you should end up boxing out a position. And in any of the software that a lot of you end up using, whether it's Thinkorswim or Livol or OptionView, if you end up putting in that reverse trade so that you end up having a long and a short put at the same strike and a long and a short call at the same strike, like you're shown here, what ends up happening is you box yourself out, and you should end up using that. Now, you do have to end up realizing if you do end up using a box or if you end up ever neutralizing a position with the strategy, you're going to end up having 2 of the 4 strikes, by definition, are going to finish in the money. Now, should you box 1 contract? Probably not, because the fees of getting executed at expiration are going to probably eat up the nickel or the dime that you might save. But if you have, you know, 50 contracts on, then you definitely want to end up considering this. The other thing that when Tom was going through this, you know, I was thinking, you know, sometimes I end up getting asked, should I be doing, and you pick any trades you want, a condor, a butterfly, or whatever, should I be using, let's say, a call butterfly, a put butterfly, or an iron butterfly? And the answer is, which one did you get better pricing on? They should all be trading the same. And today they don't move very far. But if I can end up getting one on, now you do have to take into consideration the puts may look cheaper than the calls or vice versa because of a dividend or an interest rate payment. So you got to kind of end up making sure that you're calculating that. But you try to end up doing the one that's the cheapest. The last comment I would end up making, not so much with a box, but with the risk reversal that we talked about before. when do I use a risk reversal in these markets? If you trade through either IB or live vol, and you try to short something that's hard to borrow, you'll get charged interest on it. You should end up asking your. The reason, by the way, I didn't say TD Ameritrade is that TD Ameritrade has another name for hard to borrow. They call it we won't lend you the stock, so it's impossible to borrow. So it's really not so applicable there. But in most brokers, okay, the more if you will, trader-centric ones like IB or LiveVol, I'll take a look and I'll end up asking how much does it cost to end up to short this stock, and then I'll end up taking a look at that risk reversal. I have found that in many instances, you may be able to save yourself half or more of the hard-to-borrow fee by using the options. Now, also, when you end up pricing these things out, if the puts are significantly more than the call, when you're looking at the implied volatility and some of the stuff that Tom has just gone through with you, and you are calculating the dividends and the risk-free rates and all of that stuff properly, and it's still higher, that's the hard-to-borrow fee embedded into the puts. Usually the hard-to-borrow fee that's embedded into the puts tends to end up being less than what some brokers would end up charging you on the really hard-to-borrow stuff.
Now, another point that's kind of building on what you were saying, Jim, a lot of times when I'll want to do a spread, let's say it's a butterfly or butterfly's a good example. I will pull up in whatever way I can, usually through my broker. Actually, LiveVol makes this really easy to do. I will pull up I'll pull up the put side butterfly. I will pull up the call side butterfly, and then I will look at the iron butterfly and then just do the calculation for the equivalent price. And I'll look at those three. And then whichever one I'm actually buying, let's say it's the put butterfly, I will start at the cheapest of those three. You see what I'm saying?
It's a very, very good point.
You're never going to get a better price than the cheaper of those three.
Exactly.
But you might get something between the cheapest, and you probably won't get the cheapest, but you might get something between the cheapest and the most expensive.
That's a really good point, Seth. You know, one of the things for your listeners that didn't quite get that, because I know that you know, we do this so often that it's second nature. If, let's say, that we had $5 wings on a butterfly, and it was an even butterfly and even wings, the put butterfly, okay, let's say was trading at $2, the call butterfly was trading at $2. If I do an iron, okay, when you said the equivalent, what you were referring to the $5 wing minus the $2 we would pay, so we would get the credit for $3. Correct. Those three would all be equivalent. Now, if we could get one of them for $1.90 or $1.95, that's going to, at expiration, that's going to end up giving us a better price.
Right, and what everybody needs to realize is the market makers know about call put parity, right? And so it's not like they forget. So they are not, there's a price out there that's the right price for the iron butterfly, for the put butterfly, and for the call butterfly at the same strikes. And you have to do, what I do is essentially price discovery. I don't want to go, let's say I want to buy the put butterfly and that's the most expensive. Well, I don't want to put in an order and then find out I could have gotten it way cheaper if I had done the call butterfly, or at least the call butterfly was priced way cheaper. So what I would do in that case is, assuming the iron butterfly was whatever, in between somewhere, I would start at the price of the call butterfly, and you will be surprised. Certain times you will get hit at a price well better than you thought you would have been able to get if you bought the more expensive of the two synthetic equivalents. If you were looking to buy the one that was appearing to be. And there's a lot of reasons why they appear that way. One of the issues is if you have a, let's say someone has, some retail trader has put in a price for a 1 or 2 lot. That will throw off the price of that butterfly, because the broker will typically just give you the mid price for anyone bidding for or asking for that spread. So the other side may have no retail buyers in there messing up the math. So that's another reason, a critical reason to look at the pricing of all three in the case of a butterfly, the put, the call, and the iron, because the math you're seeing from your broker may be thrown off by a tiny lot that is making the mid seem artificially much more expensive than it really is. So,
Seth, that's a great point, because I'd say that probably 90% of retail traders, when I speak to them, there's that one lot that's messing up the pricing, let's say, on the iron and the call butterfly, but the put butterfly is trading fine. And they think, oh, I'm getting terrible execution, or vice versa. Oh, they think they got great execution when they really didn't. It was that the pricing was off because one of them. So going through these things and being able to have this be second nature of which one you end up looking at, and then trying them to end up seeing where and doing your pricing, you're not going to be able to arb, quarters or $half out of the market the way, guys back in the 80s did, okay, when they were on the floor of the exchange. But you're going to be able to get a little bit better execution.
Right. And they'll be very happy to take your overpriced payment for something because you didn't realize your mid was thrown off by something that was very temporary.
Right, so or the other thing might end up happening, say, between puts and calls. There might be, let's say, a very large dividend or a special, one-time dividend that's coming out, or something else that's making the puts look a lot more expensive or cheaper than the calls. If you see something that's a $half off and there's some special dividend coming up, you're not the only one that knows that.
Right.
Okay. So, look through it, make sure that you're doing your calculations right, because you can't always just take a look at a put and use the cup formula works all the time. As Tom mentioned to you in the beginning, when interest rates are this slow and when there are no dividends, and there's no other special circumstances, the cup formula works perfectly. However, if the larger those other things get, the more you have to end up making sure that they're taking into your evaluation.
Yes, exactly. Now, so Chuck asked, why does the price vary among the three? And
Chuck, because of you.
Right, exactly. That's one of the major reasons, if not the major reason, Chuck, is that the retail trader is throwing. It really isn't going for much of a different price at all. It's just that if someone comes in and essentially, makes a bid, it's going to throw off the math on your on the calculation of the mid that your broker is doing. Do you follow what I'm saying, Chuck?
And Chuck, here's the example. Let's say one of the options was, and you're doing an SPX or a Russell, and maybe some of it's in the money, and maybe one of your options is bid at $10 and offered at $12. It's a $2 wide spread, okay? And let's say Bob wants to end up, selling this option at $11. So he puts in his price, his offer at $11. Now the market, instead of being $12 or $10 by $12, now it's $10 by $11. So
right.
The mid went from $11 to $10.50. If you're not aware of where the bigger size is and where the smaller trades are, by the way, it might not be a small trade. It could be a big institution just trying to dump these things. And what will end up happening is that there'll be artificial pressure that changes the mid price, but it doesn't change the price of the spreads.
Yeah. Another way this comes out, by the way, this issue. Tom, you don't mind us jumping in here, do you?
That's fine.
So many really important, discussions going on here. Another time you're going to find this, and everybody really has to be aware of this. When you're buying or selling a deep in the money call, which I do a lot, I assume, most people sometimes or one time or another are getting involved in it, say a deep in the money call or the deep in the money put. You're going to have a very wide bid-ask spread, as Jim mentioned earlier. Now, if you go in and you put an order in at the mid, how many of you have noticed that all of a sudden, let's say it's a call and you're trying to buy it, you put a price in and all of a sudden the mid price calculated by your broker jumps up as soon as you put your order in? Who is noticing?
Yeah, you just and BBO.
Well, right. Well, what's happened is well, that's a good point, Tom, right? You've essentially become the best price if you wanted to sell it. So they then split, if you put yours exactly in at the mid, you're automatically creating your price as the floor of the calculation. And then, so what a lot of people will do when they first get started is they get confused and don't realize they're the one making the price go up, which theoretically means you can never get the price. Well, I guess if you paid ask, you'd finally be forced to pay ask. But so you don't panic and suddenly split the difference and buy the new mid price, because that new mid number is an artificial number and you're giving a gift to the market maker. So just inch your price up from there. I mean, if the market's really moving, you might have to do more than inching. But the point is, this whole issue of the havoc created by the retail trader is a really important one to understand when you're trying to price, because good execution and good pricing is a lot of your return during the year. A lot of your return is really going to be about you being a smarter and smarter executor of trades. All right, I will now officially get off my soapbox and turn it back to Tom.
Well, I think this is my last slide, really. It's just, I think we've already covered these, that if you're synthetically long stock, you're not going to get any dividend payments, and you can't be assigned from your short option. The slippage is higher than it is for buying and selling stock, and synthetic positions generally have more strikes in play, so that makes it more difficult to get filled and has higher commission. So those just some things to think about. Not always, like a covered call synthetically is equivalent to a short put, so the short put actually has less things in play. So just in general, though. And then again, I promised the download link again, so cdurl.com/OT3 for Options Tribe, all lowercase.
Right.
And then we've been going over questions, but if there are any other questions, we're happy to talk about them.
I mean, everyone should go download these slides because it can help you. What people don't realize is if you're, a good example was, the box.
Right.
You get stuck sometimes. You could be in a complex position and you don't know how to deal with, as you're, say, exiting. You don't know how to deal with one side, or you're having trouble getting execution on one side. By understanding these relationships, you can effectively end the risk of a trade without closing every position. And people don't realize that, and it comes in very, very handy very, very often. I would say 3-4 times a year I will basically shut a position down while I still have options open, and then I'll just let them expire because they cancel each other out, and I don't have to worry about them. I assume, by the way, Jim, you seem to have a pretty good handle on portfolio margining. Would you assume that a position completely synthetically shut down has the same portfolio margin as one which has been literally eliminated?
Yes, as long as you're doing it in the same underlying in any broker, at any broker.
Right. Yeah,
you know,
I mean, of course, in the same underlying.
I've seen some people use SPX and SPY stuff for, like, for example, TD Ameritrade, Thinkorswim, won't end up giving you margin relief on that.
Right.
I have, through my Merrill Lynch clearing, they'll realize they're both S&P 500 and the margins will offset. So, yes, you really should always look at your margin calculations and look at, and everybody knows how to end up looking at that, even if they don't give it to you, okay, in a specific number like TD Ameritrade. I know, like, for example, if you trade LIVOL or IB, they'll end up giving you what your real-time margin is, but they won't break it down by position.
Right.
Look at the way it is. On individual stocks and very broadband stuff, very, very narrow things, your margin, your portfolio margin requirement will be what's the most you can lose at any point, 15% up or 15% down in the market. If you're using a leveraged ETF, okay, and it was 15% on the single, the 2 times will end up being 30% up and down. All right, they'll actually do the math on you. So don't think you can end up skirting the issue by using, you know, a triple leverage or something. You don't. On narrow band indexes, such as the NASDAQ, the Dow, the Russell, those margin requirements will end up being 10% up, 10% down. And on broadband indexes like the S&P 500, it'll be 6% up, 8% down. Now, before anybody starts jumping on that one, all of those margin requirements I gave you were the maximum when it comes to portfolio margin that they can give you. The brokers are allowed to end up changing those and having house rules, they're called, in any way, shape, or form they feel appropriate. So, for example, TD Ameritrade on the S&P 500 doesn't do 6% up, 8% down. They do 10% down. They want you to have more margin on the downside. They also end up adding extra kickers if you sell stuff naked. Okay, it's their prerogative to do so. Some brokers, okay, have a huge issue when you end up selling things naked, and they'll end up having certain additional margin requirements. The other thing portfolio margin guys have to worry about is that some brokers will end up adding extra margin requirements if you have concentrated positions. It happened to me at one broker. Even though my so-called concentrated position was in the S&P 500. And we went back and we said, guys, you can't charge me as a single stock here. It's not a single stock. It's the S&P 500. You wouldn't charge me if I bought all 500 shares. You have to realize sometimes you're dealing with a margin clerk who's never traded in his life.
Right.
Okay. So you have to understand the rules from wherever you're trading. Very, very important.
All right, now we're getting a question in from Chuck. In the box example, why is it more difficult to fill deep in the money versus out of the money options?
A very good question, Chuck, because usually what happens is the deep in the money stuff has a much higher price. So if you look at something that was super deep in the money, let's say in the S&P 500, and it was $100, okay, by $105 on the bid and ask, it was so deep in the money. You have this $5 spread. It's not that big of a percentage, right? But you can't have a $5 spread, let's say, between a quarter and 25 cents, and let's call it, 75 cents.
Right.
I mean, so what happens is that since they're so much deeper in the money, they don't want to end up being caught. The other thing is that the reason why they'll leave it so wide is that delta of that super deep in the money, it's going to be close to 1. So you could actually be buying or shorting the underlying, and they never want you to be able to end up, okay, clipping them. It's their job to clip you. That's how they make their living. So what do they end up doing? They widen out. The higher the price, the wider the spread will be. Take a look sometime and take a look at the SPX or the RUD. And as you look way out of the money, it might be, let's say, a nickel or a dime difference between the bid and the ask on on the way, way out of the money puts or calls. And
Right.
at the money, maybe it's 50 cents. And the deep in the money might be $2. You'll see at which point, okay, they change. The other thing you'll end up seeing is what's normal volume. If you're going up and down and it's 500 by 300 and 600 by 400 and then all of a sudden 800 by 1, that's the Captain One lot, okay, the retail guy who came in there and is trying to end up selling something or buying something, and they have purposely moved, well, they haven't done it purposefully, but they have moved the actual mid-price. So the mid-price is going to be different because what the market makers, okay, who are filling your spreads, they're going to end up being computers most of the time, 99% of the time. And what they're going to end up doing is that they have their own volatility models, so they don't let Captain One Lot change the way they end up feeling about where the market is.
Right.
Right?
Correct.
One of the things that I'll end up doing sometimes to see where the market is, if there's big size, okay, and you know, I don't know, I just kind of like to mess with the computers too. It's fun. I'll end up seeing the huge size on both sides, and then I'll put a one lot in, and I'll maybe bid a nickel more or offer a nickel less, and see how many of them follow me. And they'll all follow me when I move at the first nickel. They'll all, most of them will follow me to say the second nickel, and the third one I'm sitting there by myself, but I'm not getting executed. Okay, now I know where the real offer is. It was a dime better than what they ended up posting on it.
Right.
Okay.
Exactly.
And so, if you're trading any type of size, I kind of take a look at it. For me, it's pretty easy. If you're going to trade in big size, I might sacrifice one contract. Okay, so I wanted to sell it anyway. Let me see where I'm going to actually end up getting it. Okay, my one lot went off. Now let me put in the big order.
That's right.
I learned that one from Sosnoff, by the way.
What did you say, Jim?
I learned that one from Sosnoff. It's when I first learned how to trade, Sosnoff was he taught me how to end up. We were talking one time about how to find out where the real markets are if you don't have your own volatility model.
Right.
See where everybody else is. Throw in one lot. See how far you can move them.
Exactly. So, as I said, there's a lot of execution issues that through these kind of discussions and then applying, personal experience to it, it's a big deal as far as your returns. It's a big deal as far as understanding why you're not getting hit. You can have an order in for one spread on, say, the call side, and you just sit there forever, and you don't know why. You think you're at mid, but you're really not. If you look at the put side, you'll realize the equivalent spread is much more expensive than the one that you are trying to buy. And that's probably closer to the real price in that example. So in other cases, you may have found you got hit at a better price than you offered. Has that ever happened to you, Jim or Tom?
Yeah, and I get really upset when that happens.
Me too, because you realize you fell for something, right?
Exactly. I didn't do my homework. I didn't check all the things, and I got filled a nickel better. And then when I go and look at it, it was like, damn, I should have gotten filled 15% better.
Exactly.
But they stole a dime from me.
So you thought you had a great, gift, and in fact, you were giving the gift.
Yeah.
And that's because of put-call parity, because all these things are lined up, and there is a price in there at which all three were going to go, and you need to discover that, and that's the art. That's the kind of thing Jim's talking about, where you move it along slowly until you find where the real price is, and sometimes you can be pleasantly surprised where that real number is.
Yeah.
On the other hand, sometimes you can be unpleasantly surprised.
Yeah. The one other thing I do want to end up mentioning just about the execution to kind of add on to that.
Yeah.
And I'll give you a real-world professional example. I'm working on a project right now with a former Goldman Sachs guy and a couple of other folks down in Fort Lauderdale. And what they did for a living was they did ETF arbitrage. They would buy an ETF and sell its components. Okay. Their business of that ETF arbitrage, it used to end up happening, and I mean, they had some mornings in 2008 where they made $1 million before 10 o'clock.
Mm-hmm.
Right? Just absolutely, because people would pound the indexes, and they would sell the indexes and buy the underlying components, whether it be options, whether it be the individual pieces of an ETF. That business is basically gone because of all of the high-frequency computer trading these days. So if you're going to end up doing this, you have to realize this is a great benefit for you if you do what Tom and Seth were talking about. You try small orders, you put it in, you inch them along, and when you get hit, trust me, you'll get hit at the absolute best price as you possibly can. Those huge spreads between the bid and the asks, you know, those big spreads that built all of those houses on the north side of Chicago?
Right.
They don't exist anymore, okay, unless you end up, okay, being very careless and try to give your money away by putting in larger size orders with the price without realizing where you are. When you're trading a butterfly or any type of spread, if you know you're trading a 10-point wide wing butterfly and you're buying them for $1.50 and you're trying to end up making, you know, double your money and selling it at $3, you can't afford to be giving away a dime getting in and a dime getting out.
Right.
You're just giving away too much of your profit.
Correct. The other thing to realize is even though you may have a very wide bid-ask spread, it does not mean that the other side, which presumably is a very small bid-ask spread, it doesn't mean you're not going to get hit at the economic equivalent price. You frequently will. So I think it's a little, I've learned over the years, it's a little bit of a myth that you get much worse execution in the deep in the money options. I think to the extent that that's true is because of the liquidity issue more than it is the bid-ask spread itself. You know, like you were talking about, Jim, where there's just nobody interested in that option. So you're going to have to pay up for it. So
yeah, don't. You still have to be aggressive in terms of trying to get your best price. Don't trade it in size. You know, realize that most of your brokers, okay, either will sell your order flow or have divisions that end up trading against you.
Right. Exactly.
Very important for you to end up realizing. You know, as I joke with Tom sometimes, I say, you know, just because I'm paranoid doesn't mean that the guys at Goldman aren't really trying to get my money.
All right, well, I think we've gone through all the questions. I can't tell you how important this discussion was today, and experience is a lot of what makes you kind of understand these things. So, you know, you just kind of have to trade and see what we're talking about. But, you know, you don't want to go in with a giant lot size not knowing where the real price is because you're going to cost yourself a lot of money. So this sort of price discovery you do with a couple lots is very smart. And I don't really like admitting that Jim Riggio is very smart. I know that Tom Nunamaker is smart, and I'm willing
well, we both know that.
What's that?
We both know that Tom is smart.
Yeah, that's true. They want the slide URL again. Can Tom type that into the the chat, please? I appreciate it. Or you can, I can give you back the desktop and, no, actually you have
I got it.
Yeah, okay, there it is. cdurl.com/OT3.
Yeah, okay, put it to...
All right, I want to just talk about next week a little bit, so just give me a second. Then we'll technically have an early night here on the Options Tribe. So next week, oh, by the way, folks, can you see my desktop? I think you cannot because I never clicked on share my desktop. Okay, 1 second.
That'll probably do it, Seth.
That'll do it. So, all right. So Sven is telling us that he's getting an error when he's entering that URL, Tom and Jim.
Okay, hang on a second. Oh, you know what? It might be .us. Hang on. Yeah, it's .us. Sorry about that.
Oh, cdurl.us/OT3. Okay, great. All right, well, very good, everybody. Have a great evening. Enjoy the summer. I will catch you next week on the Options Tribe. We're going to have Gavin McMaster talking about options income trading in a low volatility environment. Looking forward to seeing you then. Take care, everybody. Have a great week. Thank you, Tom. Thank you, Jim.
Thanks, Seth. Take care.
Great job as always. Great talking to you.
Thanks.
All right, take care. Bye, everybody.